We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Vince Lanci, professor of MBA finance and publisher of the Gold Fix Substack. Thanks for joining me today, Vince.
Thanks for having me back, Tom. Good to see you again.
Great to see you. And you know, there's so many different things that we can always cover together, but you've recently written an article called Why This Week's Gold Close is So Important. So, you know, it seems like JP Morgan, Goldman, and even Bloomberg have been commenting on gold and talking about its performance. So walk us through what your thoughts are on why this week's close is so important.
Well, but before I answer that, the names you cited, JP Morgan, there has been an increased awareness. It's almost like they've been permitted to market for gold. It's putting my tinfoil hat on for a second. I mean, FT, Bloomberg, JP Morgan, Barclays, what have you. So yeah, I recognize that as well. That's actually a good point. Okay, but getting to brass tacks, the close today will reflect potentially, depending on where we close, the highest weekly, monthly, and quarterly close ever for gold. Now, lots of technicians will tell you this is important for bullish continuation trends, and it is. But the reason it's bullish is not really talked about. The reason that it's bullish from a technical point of view is because at the end of periods, money gets reallocated. So at the end of a week, nobody reallocates. Maybe we close some positions, right? Mm-hmm. At the end of a month, there's some reallocations. But at the end of a quarter, you have typically at the hedge fund level, you have reallocation. You have quarterly earnings. It's very financially important. And what happens in many of these macroeconomic funds, not just speculative funds like macroeconomic investment funds that hold positions for years, is after a 3-month or 6-month or 1-year period, they will take money out of losers and put it into winners. So you have a reallocation. And if gold closes at its all-time quarterly highs, that's a sign for funds that do what I described to mechanically, like they have to do it by their bylaws almost, take some money and take it out of what's not doing well and put it in something that's doing well. So you can call it a macroeconomic version of a trend or momentum type of trading. And so I can say to you with like almost metaphysical certitude that if we get that week, month, and quarterly close, you will have literally funds say, it's very mathematical. What's the bottom? Like, what's our worst performing asset? We'll take that money and put it into gold and put it into stocks. Mm-hmm. And you'll see that rotation of asset allocation. Now, I'm not saying that's necessarily, that in and of itself is necessarily bullish. Mm-hmm. More people are putting money into it. What happens after that allocation happens, you don't know. But you know, the point is, I'm saying it. It's true. It's a fact. But the people that have an interest in the market not going up, the bears, they're aware of it too. So that information should be discounted in the market. So we should see buying next week. We will see buying next week. You will see selling as well. The question is, who's going to be more aggressive, the buyers or the sellers? And that's why it is truly probably the most important quarterly close since the last time we were at all-time highs, which is like on a quarterly basis, like 2011, I think. So yeah, it's important.
Mm-hmm. So Vince, in years past, whenever they made a call like that, let's say taking JP Morgan or Goldman specifically here, whenever they made a call like that, they could take the other side of the trade from their clients and of course crush them every time. Do you think this still happens?
I think it does still happen, and I think it's not. I can tell you that without malice, these things have to happen, because when you have an entity such as a bank that can trade for itself and trade for clients, there's supposed to be a wall between them. There's no real wall between them. What ends up happening is recommendations end up getting expressed in things that complement the proprietary thing. So, for example, if at the simplest level, a bank is A bank is long on their proprietary desk gold because they're bullish from 2 months ago, right? And at the simplest, most paranoid, but it happens level, after it has gone up, the analyst says, this looks good. I think we can put it out to our public now. And the bank also can use it as an exit strategy. Do they want to crush their clients? No, definitely not. They're not. It's like, the old saw that if Goldman's bullish, you want to be bearish. Well, that's not true at all, actually. What it is there are times when a bank such as Goldman is bullish after the market has run, and they are booking profits from here, and you are getting in from here. So they're more of a macro fund trading it that way. Now, I'm not being sympathetic to that behavior. I abhor it, and I've written about it as it's a conflict of interest. You can't be an agent for someone else and a principal of your own money at the same time. You just can't do that. It's a license to front run, a license to steal. So it depends on where we are in the market without getting too wonky on it. But with regards to right now, I will say this, and it's behavior. You're going to be wrong a lot. You just have to be careful. Goldman truly is bullish gold. And people are talking about it now, but they've been writing about it in a very subtle way for 6 months. They actually started writing about it. Jeff Curie started writing about it in November of 22. He was saying things like, we're bullish on oil fundamentally over the next 18 months. Fine. And then he'd say, we think gold can go up in the next 6 months. So that, taken on balance by Jeff Curie, whether you like him or not, he's there. If he's in charge of all commodities, he's telling clients, we like both of these. We like gold now. We like oil later. So internally, they're having one of those allocation things going on too. And they're bigger and smarter clients. I key in on those early ones. Now it's like the advertising. Goldman is bullish gold. And now you're like, scarred individuals that we all are. You're like, I don't know if I want to believe it. And there are times that you probably shouldn't believe it. But just know this: I have a history with a guy who used to run the GSCI, and one time he said to me, he goes, "We're bullish oil," and I go, "I haven't seen a report on that yet." He goes, "Yeah, well, we're not going to tell you that until after we're long."
Yeah,
right. I mean, that's it. That's the truth, right? So they get long, and then the bullish oil report comes out like a month later, and I go, "Hey, your bullish oil report came out. Should I be bearish now?" And he goes, "No, man." He goes, "There's a lot more people out there that want to buy this than we thought. It's going to go up past us. Damn it! I wish we hadn't sold." That's like a quote from the guy. So they don't know much more than we do, but they are a good handicapper of when the market does what it does. You have to look at it with a grain of salt. Sure.
Mm-hmm. And of course, that's kind of a signal to the market that they end up sending, and then the market can react to that, I think, is your basic point, right?
Yeah, absolutely. The reports. So the proper way to look at reports, as you implied, is the reports serve as catalysts. It's a technician would say an inflection point. Okay, we're not going to stay here long. Goldman just said, J.P. Morgan just said, we're going to the moon. Okay, well, either we're going to the moon or we're not. So if I say to you it's going to the moon and I'm God, and we don't go to the moon, well, God is an idiot, and so now the market goes down. So the market will react typically violently to information like that. Yeah.
So, Vince, that makes me wonder, has the behavior in the gold market really changed over the last 2 years?
I've noticed some changes, subtle changes, and admittedly, I quantified it poorly, but they become more obvious. I'll see behavioral changes in a market like gold, and I'll say, oh, is this temporary or is this a manifestation of something that's permanent? And normally, I'm sitting there as a trader going, oh, it's different this time, right? We're all doing that, right? It's different this time. And then the market will, then I'll get euphoric about it. I'll get a little bit excited about my position, and then the market will reverse, and I'll go, it's not different this time. Okay,
It'll humble you.
Yeah, exactly. Humble me all the time. It's like it's my mentor. But starting, I'd say about the last time I really got humbled, like you just like gave me PTSD. The last time I really got humbled in that way was when John Paulson bought in 2011, 2012. And I've been humbled a million times since then. But the big one was he's bullish, and I was market making gold options, and I was a very big, player as a liquidity provider in gold options electronically. And he was buying calls, and I was speculating long on top of my market making duties. And he was buying calls, and he's long futures, buying calls. And I'm like, we're going up. And I was just like, it is different this time. And it wasn't different that time. Mm-hmm. What he was doing was, you find out later, is he was buying calls to get me to buy futures, guys like me, right? So he could sell the futures to us. So he was, I can't prove that, but that's what he was doing. And so it wasn't different that time. So I became a student of finding out when it would be different. So to answer your question directly, what has changed in the gold market at the structural level? Many things have changed. And there are tells out there that say it is different this time. What's happening right now? And here's the little footnote. The footnote is, it's different this time, but it won't move in a straight line like you want it to. That's the wisdom from losing money you get. But to give you an example of things that have changed in the gold market over the last 2 years, Basel III. Basel III was talked about as early as 2009. It took them however many years to implement it. And they didn't start getting serious until 2013, and then blah, 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 gets implemented. So Basel III changes the status of gold on banks' balance sheets and makes them structurally less likely, less needing to sell it to raise cash. That's number one, right? Number two, in no particular order, right? Number two, I'm like, okay, that's kind of cool. That means they're going to allocate their risk differently. I said to myself, like, oh, they won't sell it as much. Maybe they won't buy it, but they're not going to sell it every time stocks go down to raise cash. Right, that's cool. So that would put a little bit of a floor into gold. You don't see it day to day, but that's fundamental. And then JP Morgan last year, after Basel III gets implemented, they move they have a very large derivatives book, them and Citibank, and the derivatives book in gold had been kept in the FX bucket. So they have and so gold was viewed as an FX hedge. And so you never really saw the size of their gold derivatives. It was hidden from the public view, not necessarily deceptively, but it comes out to be that way. And they brought it back on their balance sheet. Now, why would you do that? They broke it out and said, look, here's our goal. I'm like, why would you do that? And that's a disclosure. They were satisfying something. They were getting ready for something. They were getting their skeletons out of the closet. And I'm like, okay, that's something. Is it bullish or bearish? I don't know, but it is transparent. And that means gold is, if you have to show transparency, then gold is becoming more important for someone, The futures participation, contrary to that, has gone down. What's changed in gold? It's gone down because this whole East-West Cold War that we're in now, this deglobalization is the word that everyone's using. That means we're not getting their commodities, generally speaking, because we're sanctioning it, or they don't want to give it to us because it's too cheap. And they're not getting our financial stuff. And so there's less money to go into deals. And so between that and interest rate hiking scenario, you have less money available for financial assets. So the derivatives pie is shrinking around the spot gold market. That whole Exter's pyramid is collapsing. They're trying to keep it orderly, but that's what's happening. So there's a lot of things going on. That's directly. Price leadership moving east, that's gotten more obvious. It's been going on since forever, but it's gotten painfully obvious in the last 2 years. And indirectly, you've got geopolitics, mercantile tendencies, and deglobalization. So there's been a lot that's changed at the structural level that people aren't really talking about at the micro level yet. No one's saying gold's got to go up, just saying it's different.
Mm-hmm. Well, Vince, maybe we could kind of jump ahead to that idea that you're just touching on. That something that everybody has been noticing, exactly as you're saying, is gold basically flowing east. So what are some of the reasons and the consequences of so much gold flowing east?
I want to tell you why I know that I'm right first, because it's not my idea. No, but so everyone's got an opinion. Everyone's got an opinion. I got to give you a little background on this, because this is me pounding a table. This is what's happening. Wake the F up. In 2000, this is like right after I got destroyed with that Paulson thing. I was like, I was brought in on a couple calls for investors that wanted to invest in the NYMEX. The NYMEX had not gone public yet, or was about to go public, and they wanted to understand about. And the guy who brought me on for the calls as an expert on the NYMEX, COMEX and NYMEX, was a guy who understood the exchange industry like no one else knew that I know. And the education that I gave him on the granular stuff was paled in comparison to what I got from him. And he said to me, I said, why are you like, he was like, tell me about this. I would be like, I was peppering him. Tell me about this exchange. Because I was thinking about putting an operation on them, and of all the millions of lessons, his name was Diego Perfumo. All of the millions of lessons that I've gotten from him, the lesson that stuck most with me was exchanges, that was his field, do best in the country of demand, not of supply. And this was based on some oil conversation we had. And what he was saying demand determines the price of commodities, not supply. It's a supply demand thing, but demand, I want the commodity, and then they start digging for it, right? And I'm like, okay, fine. I'm like, yeah, I'm a moron, but what does that mean? Well, what he's saying is all you have to do is, because his client base were these people, all you have to do is watch the businesses. And we went through it with oil, but I'll go through it with gold because that's what we're talking about here. So where's the demand for gold before 1971? Well, it's in the West, right? We'll just look at it east-west, right? It's in the West. So where's the safest place to put your gold in the West? Well, in the U.S., because there's an ocean between us and the whole European World War II stuff, right? So if you're United States, you have the strongest economy in the world, you're buying gold. You're storing your monetary strength. And if you're Europe, you're putting your money. So what ends up happening is the exchange for gold does well in the United States because the delivery points for gold are in the United States. You buy a gold contract, you take delivery, the delivery goes into a vault in the US and it stays local. So the vault business is here, the salesmen are here, the time zone operates here, it all operates here. I mean, this is gospel what I'm telling you. Like I saw it, and he just schooled me on it. And then I said to him, well, why are you looking at blah blah exchange over? He goes, well, the demand for this asset is moving there. It was Latin America. It was the BMF Bovespa, and so I started paying attention to that. And one day I saw a headline. It was like JPM is opening a vault in Singapore, like 2013, I think it was. And and I saw like 3 banks like opening a vault in Singapore. I'm like, well, that's like, this is ignorant, right? That's stupid. Who cares? I'm American. He goes, no, you don't understand. You don't understand. The vault is being opened there because the demand is there. And people no longer need to keep their gold in the US. And at the time, Germany was repatriating its gold, right? And all that stuff was going on with Venezuela and confiscating it. So the Singapore vault opens up. That means there's more transactions, there's more deliveries there. And then eventually the business moves there, the salesmen move there, the transactions move there, and then the exchange gets volume, right? And so when the exchange gets volume, and this is a conversation I had with Tom Luongo, right? You've had him on before. What ends up happening is the business gets transacted in that time zone with those people in that country on that exchange in dollars. No, it's going to be transacted eventually in the local currency. So the reasons and consequences that gold is flowing east are, at its very core, all the bullshit stripped out of it is, as an economy does better, demand for commodities go up. And as demand for commodities go up, whether it be for consumption, oil, or storage, gold, you've got to have a place to handle it. And so the economy creates a vault, creates a warehouse, creates a business, and you look at the migration of futures volumes from east to west, And you see that the interest, whether it be core business, fundamentals, using the actual commodity, is moving east. And so eventually gold, which is the last commodity you use, right? You take oil out of the ground, you make fertilizer out of it, and then you take the fertilizer and you make corn. And when it all is said and done, you go, what am I going to do with my money? You put your profits into gold. If you're looking on a commodity basis. So that the reasons are economically they're growing, right? The consequences are which is the other part of your question, is eventually the ultimate consequences. It is symptomatic of the world needing less dollars. So it's the end of the petrodollar, so to speak. So that's what's happening. It's the manifestation of the world saying we don't need the U.S. anymore. That's what's going on.
Do you think, Vince, that has also been exacerbated by, positions that they have put on the market that has eroded trust? Maybe we can use the commitment of traders report delays as an example of that. Do you think that lack of trust ends up being a symptom of that?
Yeah, I think that's a great manifestation of what we're talking about. So when things are going great, the commitment of traders report is a mistake is forgiven, a screw up is overlooked when your track record is good, right? But over the last 5 years, when you as an outsider, not as an insider, we're figuring it out as Westerners, but the outsiders have figured it out. The bloom is off the rose, so to speak. So when you see, the commitment of, like, for example, when the commitment of traders report was delayed, it was a big deal years ago. Mm-hmm. And they got it out the next day. They faxed it or emailed it to the clearinghouses, and the clearinghouses made it available on the website where they had a copy put on their desk. It was a big deal. And the reason it was a big deal for us is because we were trading off of it. The reason it was a big deal for the market integrity, to your point, is that it shows you're on top of it. Now, the advent of the internet has created systemic ease for these people. We're not getting too philosophical about it. Look, they dropped the ball. Is it their fault? Okay, let's say that they got hacked. Okay, let's say it wasn't their fault. Let's say it was incredibly extenuating circumstances. How do you not have a fucking backup the same day? The backup, I'm sorry, my calculator's not working. Take off your shoes and count to 20. Figure it out. That's your job, right? If you're, this is my opinion, right? It's not based on anything except experience. But if you don't accumulate that data just so I can make money or lose money trading. You accumulate that data to see whose positions are within limits. You accumulate that data to ensure an orderly market. So to your point, if you're not accumulating that data and you don't have a redundancy and you don't have a backup, then I don't trust you. Now, everyone's not turning off the West to go east tomorrow, but it erodes the already damaged confidence that we're getting. And so we can get into the whole they hacked themselves, all that stuff. All that conspiracy theory stuff hasn't been wrong for the last 2 years. So I'm not going to discount it. I'm just going to say there's no evidence of that, Your Honor. But I will say that if there are 10 people that put their money in gold on the COMEX, 8 of them are going to do that, right? One of them is on the fence, and another one's on the fence. And when that person hears that, at the margin you start to chip away, and then that person says, "Well, I'll put my money somewhere else." That person's not a U.S. person; it's an Asian person. It's an Indian person, and so it's a manifestation. Take it on its own. It's an isolated incident, and that's how everyone wants you to look at it. It's just an isolated incident. Well, start connecting the dots. It's a picture of a duck. And there's like all these dots connecting it. You don't have to connect them anymore. It's becoming obvious. So it's a manifestation and a a self-reinforcing, like snowball going down a hill thing happening. So it's very bad. And the fact that they haven't addressed it in a more meaningful way says that it's almost like they don't care.
Mhm.
You know, that's me projecting my own opinion on it. So.
Right. Vince, when we talk about this positioning and the behavior in the metals, we've been talking specifically about the gold market, but over this last run where we've seen gold have a good amount of strength here and gain a decent amount, it doesn't seem like silver is really keeping pace all the time. And in runs past, we've seen silver outperform gold. So what do you think is the reason why it has been, in some ways, and I would say over this period, it has been lagging gold?
Yeah, we talked about this before, and I can't get fancy about it. It's actually very simple. Historically, generally speaking, on a day-to-day basis, a week-to-week basis, silver outperforms gold. If gold rallies 1%, silver rallies 2%. If gold drops 1%, silver drops 2%. So silver is a high beta version of gold.
Mm-hmm.
And the reason for that is silver is a smaller asset. It's a smaller market, smaller asset. It doesn't digest flows into and out of it as easily. It gets distorted quickly, but it's a precious metal, and it's industrial too. We all know that. But the difference between this and what I just described is this is secular. This is central bank buying. Central banks don't buy silver. Without being negative on silver, I'm going to say in the perspective of a central bank person, gold is money, silver is not. And there are real valid reasons for that. The simple valid reason is because silver is used in industry, because silver has a practical use, you can't use it as money because at some point someone will need it to be used for electronics or what have you. So anything that is any commodity that has an industrial or consumed application cannot be money in their minds. Okay, so we're not talking about what we believe as human beings, but at a central bank. So why can a central banker store gold? Because there's minor uses for it, but because generally speaking, it's not used. It's so expensive, rightly or wrongly, right? It's so, in their mind, wrongly, right? It's so expensive that it's prohibitively expensive to use in anything as an application. Therefore, well, shit, we'll just use it to store our money. Mm-hmm. And so the same thing can be said about silver. It's not going to erode. It's not. But you know what? Silver is the best naturally occurring electrical conductor on Earth. It's better than copper. There are places where you need silver as opposed to copper, and you're going to need it more and more. And so while a central bank is buying gold, they're not buying silver. Gold is used to guarantee payment. Silver is not. Could it be? Yeah. Will it be eventually? Yeah. So that's why silver has lagged. And I got to tell you, it's kind of bizarre because I understand why silver's lagged. This is me going, I don't get this yet. I understand why silver is lagging with the gold silver thing, but why is nobody talking about silver with the net zero carbon thing? Copper. It's like, why are we not talking about silver? So I'm a little befuddled by that, and I almost think there's a conspiracy to not talk about it, and for a legitimate reason. So I think silver catches up as this keeps going. Everyone will say that to you, right? But I have a reason for it, and the reason is central banks buy gold. When the central banks are near done buying gold, or when they've gotten enough to feel comfortable, the sovereign wealth funds will buy silver. Why silver? Because they can't buy gold because they can't compete with the central banks. Mm-hmm. So India, for example, right? The central bank of India is not buying silver. The sovereign wealth fund probably is, because it's cheaper, it's undervalued, and that's what's going to happen. So I do believe as a monetary metal, silver has a ways to go, and it'll be the fever that makes people open their eyes again. But the general feeling is that it's justified in underperforming if you're looking at it only through the lens of a central banker. That's it.
Gotcha. So Vince, when we're talking about all of these, all the metals, it really makes you think about the other commodities, let's say. So are there any real correlations that you're seeing between oil and other assets? For example, like maybe if the world or the globe is going into a recession, are we going to see lower oil demand, which will dramatically drop the price of oil?
Oh, let me think about that. This is a hard one to answer because we are in the middle of something. We're in the middle of something here. And what the middle of something is the East-West split and the split on collateral. We can't get our rubber from Malaysia to make tires, so the price of tires goes up. And these correlations that we've become accustomed to, the most obvious correlations, I'll give you one. It's the most obvious correlation. Gold is denominated in dollars. If the dollar gets stronger, then then gold gets cheaper in dollars. So they have an inverse correlation. So that's the simplest, most obvious correlation that we all understand. But what happens to that correlation with what's going on in the world? Well, you have a split in the world, less dollars being used, more gold. Well, maybe gold goes up with the dollar. Maybe gold goes down against the dollar. So these correlations between gold and the dollar, and I'm giving you that because it's the most simple. It's the most simple. And so at the structural level, changes are taking place. And so at the level that we observe the correlation level, like, oh, look, that's going up, that type of stuff. Those things aren't happening anymore. And I can't tell if the correlation is broken permanently or if it's readjusting. So to your point about oil, like the correlations with oil are getting harder to perceive micro right now. Like, for example, I know that the correlation with oil and gold is going up because of the world split. Russia sells oil, Russia buys gold, simplifying it, right? China, that's it. Gold is, if you make money in oil, you put it in gold. You're not putting in dollars anymore, right? So there's going to be more money. So there's that correlation. And the higher oil goes in price, the higher gold goes in price. So that correlation is real. But you're not going to see those correlations that we used to see on a day-to-day basis. They're all screwed up. And they're screwed up for bad reasons, the breakdown of the financial relationships, but they're also screwed up for good reasons, really good reasons. I'm not just blowing smoke here. The reason the correlations with gold and other things are not holding up anymore, like for example, real rates. Gold typically will move down against real rates, right? So real rates go up, that's 2%. I'm not going to buy gold when I can have a 2% real interest rate, right? And that makes sense. But now we're seeing real rates go up and gold go up at the same time. It's happened over the last 3 months. Now, it could be an aberration, but I don't think it is. And what I'm trying to say is perceptions are changing. And because those perceptions are changing, the financialization of the West is breaking down. And so because of that, you're going to see gold is moving because people want gold. Oil is moving because people want oil. Now, that sounds like a very facile statement, and I'll tell you where it comes from. There was a trader at Goldman Sachs that I used to speak with on a frequent basis, not for any other reason except for him to school me or mentor me, right? It's back when I was on the floor. And I called him up one time and I said, hey, the yen is, it was like I forget what currency it was, but a currency was up, and so that meant gold should be down. Something like that, right? So the yen is stronger against the dollar. Why is gold up? That was me throwing that whole "I'm a genius with correlations" at him. And he said to me, he goes, someone's buying it. Well, that's stupid. The dollar is down. Dollar is up. Gold should be down. He's like, well, they don't care. They're not looking at your correlation. They just want the gold. And now I'm like, why do they want the gold? Why don't they just do dollars? He goes, I don't know. I don't care. But they want the gold for gold's sake, not for anything else. So there's going to be a time where it's like, I don't care that gold is a correlation with the dollar, relatively speaking. In a normal world, the correlations hold up. This is not a normal world. So the correlations are broken down. They'll reassert themselves sometime, but basically they're all suspended without pay. That's how I'm looking at it.
Vince, when we're thinking about this recession that, we've been talking about for probably over a year now, the idea of raising rates and tightening monetary conditions, which has resulted in the volatility that we've seen in the markets, the banks, the FX markets, was to fight inflation. So where do you see the path forward for inflation? And, with the caveat that we have seen it abate somewhat recently.
There's a lot of different ways that I can approach that. Well, what's the path forward for inflation? Is that what you're asking?
Mm-hmm.
Or is what? So I guess it's kind of a. So we'll start with I don't know, right? So I'm hedged. There's a lot of different ways to look at it. I'm kind of looking at it like this. There's the micro and the macro, right? At the micro level, inflation has backed off, but not enough. At the macro level, inflation is still too high and has a ways to come down. At the even bigger picture level, inflation is not going away. And I say this with a lot of confidence. And that's because we can't get that rubber from Malaysia anymore. We have to start growing our own rubber. It's a supply chain thing. That you can't fix that with money. So from a monetary point of view, we are doing, when I say we, I mean the Fed and the United States government is doing everything they can to lessen demand because supply has dropped, right? So forget about the fact that inflation is monetary, right? We're trying to lessen demand because we don't have as much to go around, right? So raising interest rates, destroying businesses that are reliant on capital facilitates that. But this is the recession point that you made. There's only so much in a normal environment when a yield curve goes inverted, you have recession and inflation drops. Well, right, but now we have a tailwind for inflation. So I can get really wonky on this, and I don't want to because I've been reading some quant stuff on this. The yield curve is so inverted, like the higher the yield curve goes, the slower the economy gets, right? Okay, well, we used to be in recession when the yield curve went to here. Now we're here and we're not in recession. What's going on? I don't know what's going on, but I'm going to say, hypothetically, I don't know what's going on, but I'm going to say whatever we used to use that works ain't working anymore. Therefore, this is not going to, it's going to break something as it already has. Everyone's talking about that. The path for inflation now, I'll tell you materially, I think what's going to happen. We're going to get inflation down to a certain point, and that will be hard to do because inflation is part of it is from the goods that we get, the whole rubber thing. The other part of it is from the services. Labor costs are going up. We have a real crisis in housing. We do. It's not commercial real estate, housing. That over the next 5 to 10 years, you're going to see house prices continue to go up, but you'll not be able to get money out of your house. Home equity loans will go away, and your house will be a piggy bank that you can't cash out. But just coming back on point, I think the Fed gets inflation to a reasonable level, if they can, and then they raise the target. It's going to go higher from 2 to 3 to 4%. That has to happen. I could say that to you like with a lot of confidence. And then they're going to raise the target, get the inflation to a certain level, and then they're going to have to start easing. And in the starting to ease, they're going to try it. It's like a Pozsar thing, right? They're going to have to let the back end of the curve go up, meaning we've controlled inflation as much as we can here. So now we have to let the long-term bonds go up. And that's not easy to do. If you get the long-term yields up, you end up saying inflation's baked into the economy for years. So it used to be like, let's look at it like from fundamentalists. You and I both think inflation is going to be 2% for the next 10 years. So the 10-year bond has a 2% rate, just to simplify it, right? All right. So I don't care what rates are today over the long term. So every time they raise rates, if the backs go down, I'm not saying they are, if the backs go down, that's us saying what we do now cures what will happen later, right? Well, that's not happening now. What we do now is still keeping this back end down because everyone thinks the Fed's going to buy bonds again. Right? Oh, if we're raising rates now, we're going to have another QE. So let's buy bonds and let's buy stocks, right? Well, this is going to take some time. It's going to happen. We're going to stop raising rates here, and they're going to do something called yield curve control, and they're going to encourage the inflation to move out, and you're going to see 3%, 4%, 5%, and the whole curve. Now we'll be having this conversation 2 years from now, and I'd be like, oh, what do you think inflation is going to be 2 years from now, Vince? And I'll be like, 5%. You'll say, yeah, I agree so too. And we look at the back end, and the 10-year bond is like 6 or 7%. And there you have it. So you'll have a curve that normalizes at a higher level. That's really, I could explain that better, but I just want to say that, number one, we're going to declare victory even though we haven't won, right? We're going to raise the target on inflation, and then the government's going to move towards fiscal inflationary policies with the Fed trying to control it. So it's going to be like the 70s. Fiscally, they're going to be spending money, and monetarily, they're going to be putting the brakes on. That's it. Horrible answer, but that's I got to go with that.
Yeah, I mean, it's such a complicated and complex puzzle, and we could sit here for hours and try to analyze and explain each and every single part. But I appreciate that broader view on.
I'll give you an implementation of what I just said in one trade. I'm long as a trade. As a 6-month to 18-month trade. I'm long gold and short 20-year bonds. Mm-hmm. So watch. Here's the sales pitch, and I'll tell you what the problem is with it. The sales pitch is if we have inflation, gold goes up and bonds go down. If we don't have inflation, we just go sideways. Well, if there's a crisis, if there's a banking crisis again, what happens? Gold goes up because we don't trust government. We don't trust the banks. And bonds will also go up because people will flee to that. The dollar goes up. So basically, I'm buying gold and the dollar in that sense. So in those two scenarios, I make money. In inflation, I make a lot of money. In banking crisis, I make money, and maybe a lot because maybe someone will say, "Shit, I don't want to have my money in American bonds anymore." Maybe that'll happen. The scenario now, so that's the reason that I have this on. The thing that makes me wrong is if we have a truly deflationary environment, gold goes down some and bonds explode because people just throw their money into government bonds. So my trade reflects what I just said to you, even if what I said to you was a mishmash of words.
So Vince, you do a lot of writing on your Substack about analyzing some of Zoltan Pozsar's biggest calls and his articles. I've reached out to have him on the show before, but I think because of his position, he's not allowed to do interviews or whatever the reason might be. But you do a great job of breaking down a lot of his articles. So in one of your most recent ones, you write the article War and Peace and break it down for your readers. So why don't we start with kind of the first part? What have the BRICS done and will continue to do to divorce themselves from USD hegemony?
Well, starting from high level and going to granular, for whatever reason, the BRICS said we're not getting a fair deal on this dollar stuff. Our currencies are too weak, our economies are suffering for it, and therefore we're going on strike. Right. So the BRICS labor and raw materials are being withheld. Now, not literally being withheld, but they're slowing down. COVID showed the weakness in supply chain. Sanctions against Russia. So we're less accepting of their materials, and they're less giving of it. So the reason that they're doing that is because they simply don't think they're getting paid enough for their assets. They're underpaid, right, for their labor and their materials. And so they recognize or believe that the problem is the dollar. So they want to free their currencies up to be less tied to the dollar, because the dollar is this world standard. So how do they do that? Well, if you just break up off of the dollar, you're going to cause mayhem in their own economies. So what they need is they need a bridge. They need a bridge from the dollar to what's next. And it seems that they want the yuan to be next. And that because it's the biggest economy out there. But the yuan itself China's economy is as big as it is nowhere near the United States in terms of its network effect and in terms of its reliability of its liquidity. So China is creating a bridge, and they haven't overtly said it. They pretty much almost overtly said it now. But gold, and I'm not selling you on this. This is what they're doing. Gold is it's a fungible, agnostic, no counterparty risk commodity that they all have and they all believe in. And so they're going to say, we're going to use gold as our international trade, and we're going to slap the yuan on top of it. And we'll just that's what's going to eventually happen.
He also revisits Harry Merrilling's 4 prices of money concept as a framework for diagnosing where the aforementioned BRICS behavior could cause the most trouble for Western dollar-based markets. So, again, you broke that out into those 4 pieces in your article.
Right.
So how does that end up creating, trouble for these Western dollar-based markets?
This 4 price, by the way, I'm going to call this what this is. This 4 prices of money stuff that everyone actually got interested in. It's really the Exter pyramid. It really is. If you look at if you can imagine the Exter pyramid, what are his 4 prices? I'm pulling it up on a screen right now. What were they? The price level of money, that was one, right? The word par, right? And then interest on money, and then Forex on money, something like that, right? Well, if you take I have a picture that will actually explain this better than me, but basically says there's 4 definitions of money. He really mixes his metaphors here. There's 4 definitions of money. There's 4 prices of money. I'll tell you what he's doing, guys. Tom, he's describing the Exter pyramid without saying it, right? There's 4 definitions of money. At least I can actually find the phrase. I don't want to take up too much time looking for it, but it's actually, here we go. Price level. That's one definition. Par, interest, Forex. Okay. I want you to look at it this way. When you look at the Exter pyramid from top down, at the very bottom, it's the money itself. It's the US dollar, we'll call it, the dollar, and whatever you have guaranteeing it, right? And then above that is your first derivative level. It's the FX market. And then above that is the interest rate market. That's your bonds. And above that is the stock market. So stocks collapse, bonds collapse, as the pyramid collapses, stocks collapse, bonds collapse, fiat currency collapses, and then you get to your real money. Well, that pyramid in their mind, in that banker's mind, is the dollars at the bottom of that pyramid. And most of us are like, well, at the bottom of the dollar is gold when it really comes down to it. So what he did, what was interesting is he said, and this is actually, I think, very important. This is where the whole yield control curve comes in. For the last, 20 years, we've had a Fed put, and that put has been underneath asset prices. Stocks are not going to go down. We're going to make sure stocks are stabilized. Fine. All right. He's saying that the Fed put was removed from stocks and is now being put under bonds. So we're going to sacrifice or triage stock values and retrench and pull back and defend bonds, because if it gets past bonds, then it's going to destroy the currency, and if the FX currency. If it gets past that, you're at the base, and the base will be gold again. So the 4 prices of money is really just a convoluted way of saying we're going to let stocks drop. We're going to defend the bonds. If we lose bonds, we'll defend the currency. And if we lose currency, we'll say, shit, we're going back on a gold standard. So that's what he's saying there. I hope that helps a little bit. It's a rework of the pyramid. That's what it is.
So the next section is what he believes the US Fed will do to combat the effects of this de-dollarization on the West market. So, we talked a little bit about the yield curve control that could come from the Fed.
Right.
But one of the other pieces I wanted to maybe a more realistic piece of that we could talk about is the extent of the lessened demand for US treasuries right now and the consequences of that for the US. We've seen China, for example, selling their US treasuries. So what does that mean for the US with this, dropping demand for US treasuries?
Yeah, that's exactly right. He's saying we're not going to defend stocks anymore, we're going to defend bonds, right? So how are we going to defend bonds if no one's buying them anymore? To your point, right? No one is an extreme example, but that's going on. There's less people buying them. In fact, Japan was selling our bonds to defend their own bonds, but that's another conversation. How do we support bond prices when people are selling them? We buy them. I'm not even being like, we show the world that we're not scared and we buy them. And that's what we're going to do. And that's what yield curve control is. So what's going to happen is, it's important to look at bonds and currency this way. People don't look at it anymore like this, but this is how it was taught originally. A currency is the stock price of a country. A bond yield is the dividend on the stock. Okay, so if your currency sucks, like your government is stupid, they don't know what they're doing, they're poor managers of the economy, well, your currency drops. And when your currency drops, because people take their money out of the country, your interest rates go up. Your interest rates go up to a certain point, right? And then they say, 10%, I'll take the risk. And you put your money back into the country. And that's basically how stocks work too, right? Well, what's happening now is, to your point, is the dollar is strong because of the trust in our way, our government. And so the strong dollar means, well, the dollar is really strong, it's really safe. I don't need a big interest rate, right? So now if people are selling our bonds to put it in something else, something more worthwhile, maybe something less risky, maybe something with more payout, that's going to put a higher interest rate on our bonds, right? If we don't, and here's the key, if we don't, this is what's going to happen. This is it, right? If people are selling our bonds, then the interest rates are going to go up. And doesn't mean the dollar goes down. They'll keep their money in dollars because you can always put money back into the bonds at the higher interest rate. And that's what's going to happen. It's like the bond yields will go up as people take their money out of bonds and put it into stocks. The government's going to step in and say, this is where how do we stop it? The government stops and says, we're just going to buy our own bonds. Screw you, right? So the government says, and this is yield curve control, the government says, we're going to do a form of QE, quantitative easing, called yield curve control. We're not going to go out there and say, we're buying all the bonds and we're going to keep buying them until you put your money in stocks. We're going to say, well, the interest rates are going up because you people are selling bonds. Well, we're going to stop yields from going up. It's going to get to a certain price and we take on all comers. And that's yield curve control. So you start getting this thing I talked about, the backs go up, and then the government goes, boom, we'll buy all you got at this price. You can't fill me. I'm a monster. And then the government gets tested by the market. Well, what ends up happening is, assume that the government wins. This is key. Assume that the government successfully represses long-term interest rates so that they're too low compared to what they are in other countries. Too low, right? So what'll happen? People say, well, I'm not going to keep my money in dollars anymore. And the dollar craps out. So, and you can put on your tinfoil hat for this one and you'd be right. The government is going to engage in something called financial repression. Financial repression, among other things, simply says this: we're going to punish people by virtue of our behavior who do not adapt. It's a very Darwinistic thing. And it says, we need, back to the pyramid, to keep our currency strong. And so we're drawing a line at the bonds, because if the bonds go, the currency goes. If the currency goes, it's over. It's all downhill, right? So we're stocks, we're sacrificing them. Bonds, we're drawing a line. Bonds are not going up. Now, the signal we're sending to the world in a positive way is, you know what? we have so much confidence in our future, we're going to buy our own bonds,
Mhm.
right? You know, you have confidence in our future, you have confidence in our people, you have confidence in our innovation, whatever you want to call it, you have confidence, right? And so can we keep doing it? Yeah, we can keep doing it until we can't. I don't know when we can't do it. It goes on until the world runs out of fuel and says, okay, you're right. And they put their money back in. Meanwhile, we're trying to get inflation down. What the byproduct is, as this is happening, this is Pozsar talking, not me, right? As this is happening, and we haven't gotten there yet, but we will. As yield curve control is happening, we will keep the interest rate artificially low. So you and I are, oh, we can go get a mortgage for 5%. No. Mortgages will go to 10%, but you know the bond will be at 4%. Like, well, why is that? Well, because the interest rates don't matter. Interest rates don't matter if they can't give the money out, if they don't have it. Interest rates, and so people are like, well, if I can't buy a house with a 4% mortgage and the bonds are only giving me 4% interest rate, well, screw it, I'll buy a house in China. And so the money leaves the dollar. So what we're going to recognize as North American, Canadian, and Americans, what we're going to recognize is that slowly, frog in the pot of water, we're going to slowly get boiled, and our buying power will diminish. It'll be it's the behavior. It will be very much like the 1970s. They give you all these fancy words: yield curve control, financial repression, permanent monetization of debt. It means we're hiding the fact that we're debasing the currency. That's it. And that's what Pozsar said. He didn't use those words, but that's what he said. We're going to defend the bond market, and we're going to bet that we can outlast everyone else. And that's it.
Mhm. Yeah, I think the important part about that yield curve control, and we've seen it in Japan, is, you know, recently, is that it puts at odds the bonds and the currency, right? And
that's it. Exactly.
Yeah.
And you can't fight the government. So let's say we run a hedge fund, and we're looking at Japan. It's like, oh, you know, the Japan yen is really the Japanese yen is too. We look at it as quant analysts. We say the Japanese bond the JGB is only yielding whatever it's yielding, 2%, and the currency is too strong for that. Either the currency is going to go down or the bonds are going to go down. And so we short the bonds, and the government says, I'll buy them. You're an idiot, right? And they outlast us. So then we say, all right, well, then I'll just short the currency. And that's what happened. The Japanese yen, before they started yield curve control, started climbing, or getting weaker, I should say, aggressively. So it stabilized. And after it stabilized, they implemented YCC. So now you and I, we're going, okay, we have a fund. We're like, we can't short the bonds because we're going to get away. But we'll let, they're not going to stop us from shorting the currency. Short the currency, right? So we short the currency and we're making money, and it's getting slaughtered. And we're like, yeah, we're right. Disconnect is there. And this is to your point about the whole disconnect. Then Japan says, well, shit, we've got a ton of American treasuries. They sell American treasuries, take those dollars and swap them for yen and manipulate the yen up. And so the ripple effect from their manipulating the bonds is the currency goes down. And then they throw that ripple effect out, and now the US bonds get slaughtered. And that's what happens. So it's like this musical chairs or find the P. Like, where's the government intervention? Where's the manipulation? Well, right now it's like Japan worked. People are like taking their mind off of Japan. Now it's in the US. Now it's in Europe. So it's you have to stay one step ahead. And you can either stay one step ahead, constantly dancing, or you can have a percentage of your assets, a decent percentage of your assets, in something that doesn't care about what people do. And that's, silver and gold and Bitcoin.
So, Vince, what is the bottom line here? What is the actionable advice that we all need to consider as investors that Zoltan writes about there?
He writes so I understand it. So what does that say about me? When you compare him to someone, let's say like Michael Hartnett will say, this is going to happen, that's going to happen. He's like, and Zoltan is like the George Carlin routine about baseball. Zoltan's like, well, you should buy the 3 goals. He's like, All right. So anyway, what does he say about the three golds? What are the three golds? The yellow gold, black gold, and what's the other one? Lithium? Is that the white gold?
Mm-hmm.
Yeah. Okay. So he said that he'll give you like these incredibly specific ideas, like you should buy lithium, you should buy black pepper, or something like that. And then he'll give you this whole like, and you should buy the Three Little Pigs or something. I'm like, what? And it's really hard to figure it out. But what he's really saying is I kind of translated those. And that was like my biggest proud moment, trying to figure out what the hell he's talking about. The three golds refers to, traditional industrial commodities. Maybe they're going to get rid of oil and we're going to replace it with some unicorn that poops ice cream, and creates energy. I don't know. But until we do, you have to own black gold. Boom. And that means you have to own industrial commodities. Second under black gold, you have to own copper. It's industrial and it's also green, right? What's the next gold? The next gold is yellow gold, right? All right, so you have to own yellow gold because it's a monetary metal. Okay, it's not a commodity that gets consumed. It's not a commodity that cures carbon. It's a commodity that isn't a commodity. It's money. You have to own yellow gold because it is the different one, right? And second on that list is silver, right? So because it's a monetary metal, and also silver is a green metal. So there's reasons for that. Like there's the secondary place. And the third one is lithium, and lithium is his way of saying lithium is the renewable energy, the green economy, and lithium is, like gold. You look at other metals like cobalt and nickel to a lesser extent. And so under lithium, you have lithium, right? And then your sub ones of that would be copper because it's green, right? And then silver because it's green. And that's basically it. So his three golds are basically three divisions, right? One is own a piece of the old economy, right? That's black gold. Own a piece of the potential new economy, that's white gold. And the yellow gold is own the bridge from one economy to the other. And that's gold because it's not going to lose its value until they figure out how to synthesize it or use it, in a chocolate bar or something. I don't know. But that's it. That's the three golds. He's like, oh, buy this gold, buy that gold, buy Bavarian, beer steins. I don't know, but it's like, it's industrial commodities, traditional industrial. So that's owning a piece of the East. If you own oil, you own China, right? If you own gold, you own China and the US. If you own lithium, you own whoever wins,
You own the future, maybe.
Right. Well, right. Exactly. The future. And I reason I said is whoever wins because we want the lithium because we're like so renewable, but like they have it apparently. So I don't know how that's going to work yet.
Right.
But that'll be a fight.
Mm-hmm. Do you think there's anything else worth covering on kind of his idea of the actionable advice to investors?
Yeah, there's a lot. There's a couple things that I could say in very synopsis type form. The whole stuff we talked about with the currency and all that stuff. He says, I forget his exact words, but he basically says, dollar buying power will weaken as a consequence of the globalization, but it'll remain the strongest among the Western countries. So it's the tallest short guy, however, it's the cleanest dirty shirt, however they say it. So what he's saying is, the dollar will go down in value against commodities. And so if you're in a business that needs a commodity that we don't have enough of, then you're buying, if you need to buy, let's say your business runs off of, dim sum, and that dim sum comes from China. Well, your business is screwed because you're not going to be able to buy what you used to buy for dim sum. But I can't emphasize this. Over the next 5 to 10 years, the dollar's buying power will weaken, just like North America's industrial complex weakened, just like businesses left America for Mexico, weakening our base. Everything is going to weaken. So NAFTA and things like that, balancing the world. Well, the world balances by them going up and us going down. And that's what's going on. The thing that makes me wrong would be if we had uh, an innovation that came along tomorrow that made oil not needed, that was a substitute. It's like we have this new thing that's just as good as dim sum. It's I don't know, it's fried gyoza. It's a Japanese dumpling instead.
Right.
That's the most important thing. The dollar is going to be the strongest Western currency, but it will lose value. It won't be dethroned. It'll lose value relative to Eastern counterparts.
Mhm. Excellent, Vince. Well, you do a lot of writing and a lot of, let's say, translating based on those articles, and I think
Right.
a lot of your readers find it really valuable.
Thank
So I
you. I
think
hope they do.
yeah, and I think it's worth checking out your Substack over at goldfix.substack, because it's a great way to have a lot of this high level stuff be more approachable.
Thank you. I appreciate that. We sometimes I get a little bit out there, and sometimes I'll get a little bit granular. Like right now, I'm thinking granular because gold, the end of the quarter. Like I'm waiting for that. And we also get some good research from banks that the premium folks get to see once in a while. Well, they get to see them more than once in a while. But yeah, I think there's a little bit of there's something there for everyone if you have interest in investment in precious metals, obviously,
Mhm.
and macroeconomics in general. So yeah, thank you very much for that.
Thank you, Vince. Do you think there's anything else worth touching on before we wrap up today?
I do. Do you remember when you're probably going to sue me for this, right? Do you remember when we talked like about a year ago, and we might not have even been on camera. We were talking about what do we have to get people to get interested in precious metals?
Right.
And it might have been you that said we should just need to put like topless girls. I don't know that you said that, but do you remember that moment?
I think what the basis of the conversation was something more like, sex sells, and how do we make gold more sexy?
Right, there you go. Okay, right. I'm sorry. I don't want to. If you're married, I don't want to get you in
Oh,
trouble.
it's all good.
Right, that's what you said, right? So uh, that stuck in my head, and about 2 months ago, I put out something that I felt was incredibly important, and no one cared about. And I'm like, you guys are morons. You're just thinking that you're a genius, right? You got, and I typed something like on Twitter. I said, what do I have to just put like naked pictures of girls here with a gold chart? And this Twitter mutual, Ahafia, she's like, hey, that's a good idea. And I go, what do you mean? And she's very bright. She's also very precious metals oriented. And so we partnered, and I'm involved with her professionally, where I take this research that I get and I'll pick a chart that's relevant to everyone's interest. I mean, really current stuff, like stuff that came out today or yesterday, not stuff that you read 2 weeks from now on CNBC. And I'll say, this chart is really good. And I'll write a little note about it, right? And then she will pair it up with something that's aesthetically pleasing. And she'll put it out there. And there's been a great interest in this. And what do we call this? And she said, rather professionally, believe it or not, she said, we'll call it boobs and bullion.
Mhm.
Right. And so the Twitter account at boobs bullion was created, and we'll put up, well, she does most of the work. I'll just give her the research, and we talk about, there's a community of people that's being formed, and they ask questions and I answer them. But primarily it's like, how do you get middle-aged guys to look at gold stuff? So it's, when we were kids, our fathers used to say, I read Playboy for the articles. So now you like go to Boobs and Bullion and say, I surf that site, that page for the gold material. So I wouldn't. There's nothing. We're not looking for money here. It's a public service, and she puts a lot of time and effort into it, and I'm her partner on it. So I'd encourage you to go there. That's the other thing I would say.
Perfect. Yeah, it gives another avenue into the precious metals, right?
Right, but listen, if I have lawyers if you're gonna take a lawsuit out of me for stealing your idea. But yeah, I have to say that you're probably partly involved. The other thing that I wanted to mention is that about 3 months ago, And I asked to check, make sure that you wouldn't that I won't be doing anything inappropriate. But on Mondays, I do a 15 to 20-minute broadcast, kind of a podcast at Arcadia Economics, Chris Marcus's, and I have a lot of fun doing that. It's very silver oriented, but it's a lot of fun. And if you want to see me, you can come there. Otherwise, come here.
Yeah. And of course, your ghost at Sorenthek, SORENTHEK.
Yeah, exactly.
As well,
They'll
right?
find me. I'm around there somewhere. But yeah, my ghost. I was banned before, so that was my old backup account. I used to read a lot of philosophy, so it's Soren, Kierkegaard, and like, okay, I guess I'll use this stupid account. So that's what I'm using now. Yeah, they'll find me. I'm out there somewhere.
Excellent. Well, there's all the avenues for those that want to hear more from Vince. Vince, I want to thank you so much for your time today and sharing your thoughts with us.
Thank you, Tom. I appreciate it, and I hope to see you soon.
Absolutely. Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.